This section has the title, The Macroeconomics of Taxes and Tax Reform. It's a lecture I've been giving for several years at the Mises Institute, and I started giving this lecture back when we were running $200 and $300 billion deficits. Interest in this lecture then has lapsed for a time, and now it's back. Okay, we've got the deficits back. Got my topic back. It's fun again. So I'm happy to be able to give the lecture this time. I might start with a little political preface, because a favorite book of mine from years back was one by Franz Oppenheimer, who wrote a book called The State, published in the early 20s. And in that book, he identified two methods of acquiring wealth. And one was production and exchange, and he called this the economic means. And the second one was confiscation under threat of violence, and this he called the political means. And then he defined government as the organization of the political means. All right. Now this gives us a very radical view of taxes, and in fact, if I adopted that view and stuck with it, this lecture would be pretty short. Okay. What can we say about taxes? It's theft. We're against them. End of story. All right. And that would be it. But that wouldn't quite make full use of what we know about economics, and so. We want to ask a number of questions about taxes and about the alternative deficits, and see what we can say from an economic point of view and even a macroeconomic point of view, as advertised by the title. These slides that I have today are mainly to keep me from having to write on the grease boards, because my handwriting is just is slightly inferior to George Reisman's. And so I won't do that. But I will raise and answer, at least partially, a number of questions. Does the tax take measure the burden of government? A second question, are all taxes dollar for dollar equally harmful? And you could guess the answer to that. But my preface is partly to make room for significant answers to that kind of question. You might want to consider all taxes theft in some political, philosophical sense, and still be interested in asking, well, which taxes might be more harmful or less harmful than others. One thing I'll spend a good deal of the time on during this period is this third question: are taxes better or worse than budget deficits? And here we can find lots of scope for disagreement among the schools of thought, and I'm not even sure there is something you would call an Austrian position on this issue. But I have written on the issue and pointed out some particular harmful effects that come from deficits, and so we certainly can't conclude that taxes, in fact, are categorically inferior to deficits or better than deficits, but we'll see how that goes. And what's the case for the flat tax? This is a proposal that has gotten some hearing during the last presidential election, the last couple, where we had Steve Forbes in play, who was an advocate of flat tax, and we've had book-length treatment on it by Hall and Rabushka, who have some connection with the libertarians. So we want to look at the flat tax, and lastly, look at the consumption tax. Is a consumption tax preferable to an income tax? And by the way, the Hall and Rabushka flat tax, so-called, is actually a consumption tax, although that fact sometimes is hidden away in some of the rhetoric of the flat taxers. So those are the questions we want to ask, and I want to deal in fairly short order with this first one, because I can draw on Milton Friedman with some approval, but I'll take issue with Friedman on key points as well. But he has a point. He says government spending, rather than the total tax take, is closer to the mark in gauging the burden of government. All right? And you can see how he's thinking. You can see what he's all about. He's saying that, look, there are resources out there, and the private sector would like to be able to take command of these resources and do with them what it wants. Unfortunately, the government is taking command of some of those same resources. And given what government takes command of, determines what's left over for the private sector. And so Friedman's point is that, well, the government can take command of those resources in various ways. It can tax people and use those funds to take command of resources, or it can borrow funds and use those funds to take command of resources. And in both cases, it's taken resources away from use in the private sector. And so G, rather than T, is a better measure. Government includes both tax-financed appropriation of resources and deficit-financed appropriation of resources. But there are two instances of appropriation of resources. Now, I would take issue with this in two ways. One that would be actually just a friendly amendment that I think Friedman would accept, and the other an amendment that he wouldn't accept. Okay, because when Friedman writes a statement like this about government spending as just the two ways of appropriating those resources, he says, therefore, that in the difference between that, the difference between taxes and the deficit is very much a second-order consideration, almost an nth order consideration. It's trivial relative to the question of the total amount of government spending. All right, so we can ignore just how the government is appropriating the resources. The fact is, it's appropriating them. All right. Now, what I'll argue later in the lecture, we're going to stay on this question for a while. I'll argue later in the lecture that it does matter, and it might matter, and it matters in circumstances where you have chronically large federal budget deficits. Right? I don't want to be too uptight about government borrowing in the sense of mandating some balance on a monthly or weekly or even annual basis, but rather if you have a period where government is outstripping its tax revenues by hundreds of billions and doing it consistently over a period of time, that can make a big difference, and that kind of appropriation of resources can actually be more harmful than had it collected them in taxes. The friendly amendment, I cite Dick Wagner because in a paper I wrote I was using an article of his, but I think I could cite probably Tom DeLorenzo as well. If the objective is really to assess the burden of government, it's not just taxes and deficits, but all sorts of regulations as well. In fact, what Dick Wagner points out is that virtually any kind of a tax and subsidy scheme has an equivalent in the form of regulation. And either way, it turns out to be a burden on the private sector, however it's imposed. Let me give you an example. If the government, in all of its wisdom, decides that automobiles ought to get better gas mileage than they're actually getting, never mind what the current technology is, and never mind how much the consumer is willing to pay for a more fuel-efficient car, if it's decided that the efficiency ought to be greater. You can think of a couple of ways to do that. One way would be to collect taxes from the tax-paying public and then to use those funds to subsidize the automakers into investing more than they otherwise would in designing cars that are more fuel efficient. Okay. And of course, if it did that, then that would count in as part of the burden, or even if it borrowed the money and subsidized the automakers to find more fuel-efficient ways of designing cars, that would count in the burden, even in that first line, right? But it's just as much of a burden if instead it uses regulation, if it just mandates that within 3 years or whatever it is, gas mileage has to be thus and so. And of course we've seen that in a very dramatic way where the government imposes a called CAFE standard, C-A-F-E. The F-E stands for fuel efficiency. I forgot what the C-A stands for. You probably know. They mandate fuel efficiency, and yes, you know.
It's corporate auto fuel emissions.
Okay, there it is. Well, I had one letter right, the fuel. Okay. So anyhow, those standards which apply to the whole fleet of automobiles impose a burden on the public because they end up paying for more efficiency and so on than that they were actually willing to. So we'd count regulation into, I think it would be a friendly amendment as far as Friedman is concerned. And so my key focus is going to be on this issue of budget deficits versus taxes. Now here, let me make a political point that is very much worth making because it might make you more receptive to the rest of the argument. Suppose that we are to find that budget deficits in some contexts, namely chronically large budget deficits, are actually more harmful than some equivalent amount of taxes. And we need to follow our economics wherever they will lead us. Does it then follow that we would recommend tax hikes? Okay. That we'd recommend repealing current tax cuts that are on the books or whatever. And I say no, it doesn't, because there are lots of political considerations, namely that from a political point of view, increasing taxes are much more likely to result in increased government spending than in reduced deficits. Right? And that certainly has to be taken into account in a big way. And I think that when push comes to shove, that would dominate a decision of some libertarian-minded citizens to oppose tax increases. They wouldn't want tax increases simply because they decided that budget deficits have a certain harmful effect, because the tax increases don't reduce those deficits. They rather increase government spending. Nevertheless, we can realize that and not recommend tax increases, and at the same time we could recognize that for a given level of government spending, if we can take it as given, then we may well be better off if it's paid for up front, cash on the barrelhead and so on, by the taxpayers rather than paid for by chronically large deficits, which might come back to haunt you eventually in ways that are worse than having to pay the taxes. Okay. Are all taxes dollar for dollar equally harmful? I mean, this is sort of a interlude here to get before we get to the big issue of the deficit, because we really can't compare deficits with just taxes per se, because some taxes are worse than others. And we have to recognize that as well. My supply side friends keep reminding me of that. And so I'll acknowledge it up front. And generally, the narrower the tax base, the greater, or at least the more concentrated, the distortion of economic activity. And here a good example is what came to be called George Bush's yacht tax. This is the Bush the elder who managed to propose and enact into law a yacht tax when he was president. And the yacht tax was just the familiar or common name, but it was a tax on luxury vehicles, including marine vehicles, includes automobiles too. And at the time, any automobile that sold for over $30,000, that's actually not all that luxurious these days, is it? How many sell for less? So any vehicle that sold for over $30,000 would be subject to the yacht tax, or subject to the luxury tax, and certainly yachts would be subject to the tax. And the idea, you can see what it is. I mean, it's a pretty superficial, naive idea. Who are these people buying these things anyhow? Well, they're rich people. You know, they're the ones that ought to pay the tax. So, and it had political support. It was very politically popular. All right, and yet had tremendous distortions in the different markets, and particularly in the shipyards that made yachts. if you stop to think about it, you can predict exactly what would happen. And I'm proud to say, actually, that in my principles class here at Auburn, when this yacht tax was first proposed, we did a microanalysis of how this tax is going to impinge on the different people, and we called that one right. Okay, we saw just what was going to happen, but it took politicians some years to see what was going to happen, and finally decided, no, this is not what they had in mind at all. All right? Well, now what happened? Think of it in terms of the yachts. Who buys these yachts anyhow? Well, it is rich people, pretty wealthy people. All right, although the marginal yacht buyer, marginal yacht buyer considers a yacht to be a big ticket item. Now, I know there are some people that are so rich, that they could buy a yacht a day and not worry about it. But that's not what drives them. All markets are driven at the margin, aren't they? And so the marginal yacht buyer, even though he's rich too, it's a pretty big ticket item even for him. Further, it turns out, and you're not going to be surprised at this, is that for wealthy people that have money to play with, there are lots of ways to play with it. All right? I mean, that's why people like to be wealthy. There are lots of ways to pay with. Which is only to say that there are lots of substitutes for yachts. Lots of substitutes, ways to spend your recreation dollar. All right? And so the immediate result is that at the margin, people quit buying these yachts, and they would do other things. What other things? Well, lots of other things. Okay, maybe no two of them did exactly the same other thing. It's not that there's some technically defined substitute, that they bought private train cars or something like that. That was an earlier period. Okay, they did all sorts of things. They may just spend more time, on the Mediterranean or whatever, or think of other things to do with their dollars to play with. So the demand for yachts went way down. Now, this impinged very dramatically on shipyards and the building of yachts. Now, let me test your instincts. Who works at these shipyards, anyhow? Is it another group of rich people? It's by and large poor people working at the shipyard. And a lot of them suffered decreases in wages and layoffs and lost their jobs and so on. And studies done months and years later showed that this tax was impinging not on the wealthy, but on the shipyard workers who were in the lower income classes. And for that reason, so here's an empirical truth sometimes gets the attention of politicians. For that reason, the yacht tax was eventually repealed. It just wasn't doing what they'd hoped it would do. Right? Okay, so you can see that some taxes are worse than others, and here's one that it was worse both. It's bad both in its intentions and its consequences. Where are you out there trying to stick it to the rich? I mean, what's going on here anyhow? What's wrong with the rich? And then you find out, well, you really stuck it to the poor. So anyhow, taxes can be bad too. I don't want to downplay that. And I make the point here, and again, there's some ambivalence. When you deal with taxes, and especially if you grew up reading Franz Oppenheimer, there's always some ambivalence in the way you go on these issues. The broader the tax base, the less distortion of economic activity. Of course, the broadest tax base is simply all of income, gross national product or total income, and you can raise the same funds with a pretty low rate. That's not going to have any major distortions like something like a yacht tax. Although, even thinking here, you could imagine some hardcore libertarian thinking maybe the narrower the base, the better. In other words, if we could somehow write it into the Constitution that the only thing that could be taxed was raspberries and anchovies. Okay, that's it. It might have a lot of distortionary effects in those markets, all right, but it would sort of limit the amount of taxes that could be collected. Where if they can tax all of income, they can inch up that rate and get a lot of money. Well, we'll see later about this flat tax and how that might help in that regard. Okay. So income tax with a low rate is going to raise a whole lot more money than, or it could, it could be a very, very low rate and still raise the same money as the yacht tax and without doing the damage. So are taxes better or worse than budget deficits? We've got to this question now. And start out with an aside, because it's sort of interesting. I don't see anybody else picking up on this. But back in the 60s, when the Keynesian slogans, mottos were popular, if somebody was worried about the deficit, what's the slogan that was supposed to do away with those worries? You remember? You remember? Well, okay, but yeah, that's certainly true. This is used for stimulation, raise income. But who do you suppose we owed these deficits to? We owe it to ourselves. Okay, so this is I think I associate this with Abba Lerner. I'm sure he's not the first one to say it, but he certainly popularized it. Don't worry about the deficit. Of course, he was the one that designed all the so-called functional finance. In other words, he took the Keynes' general theory and went wild prescribing policies of fiscal policies and tax policies and so on. Don't worry about the deficit because we owe it to ourselves, right? Now, of course, some of us owe it to others. That's the problem. But we owe it to ourselves. Now, what's interesting to me, to make this aside, is that that's not the claim anymore. That's not the claim anymore. See, if we owe it to ourselves, that suggests that, oh, look. The portion of the borrowing we're doing from other countries is not very great. And largely we just owe it to ourselves. So don't worry about it, okay? As if if we were borrowing a little too much from other countries and owed it to other people and not to ourselves, well, okay, then we might be worried. But we owe it to ourselves, all right? But now it's precisely the opposite that's being claimed, What about this deficit? George Bush is somewhere now between 200 and 300, closer to 300 and headed to 400, all right? And that's something to think about. And in fact, if it gets up to 365 billion, it might be about that level now. That is $1 billion a day, isn't it? Borrowing at about $1 billion a day clip. Okay, but don't worry because is it because we owe it to ourselves? No, I'm sorry, ourselves don't have that much to lend. So we owe it to ours, but don't worry because we have access to world capital markets. Okay, that's an umbrella. In other words, because we don't owe it to ourselves, we owe it to all these clowns out there who keep loaning us money. Don't worry about it. And I've looked for estimates of how much these world capital markets have to lend, and I can just see sort of airy estimates in the tens of trillions of dollars, because tens of trillions of dollars in world capital markets, and what we're borrowing is just a drop in a bucket, So you get up to hundreds of billions of dollars, and it's really just a drop in the bucket compared to these world capital markets. And this, by the way, the business of we have access to world capital markets, this isn't coming from the leftish Keynesian economists. This is coming from the supply-siders. Right? Supply-siders say, don't worry about the deficit because we have access to world capital markets. And I saw something from one of the think tanks, I won't say which because I'm not absolutely sure I got the right one, but one of the supply-side think tanks in Washington that simply says this is the closest thing we'll ever see to a free lunch. All right? So we'll see how this works. One of the things I have to deal with, and it seems odd really to have to deal with it, because if the government's borrowing at a clip of around $1 billion a day, how much time we want to spend arguing that's a lot of money. All right? I think it is a lot of money, even in the context. But you hear a lot of apologetics on the grounds that, well, that's not much compared to something else that's much larger. And in fact, let me show you some of the comparisons, and you get a sense of it. This goes back, to the Keynesian period, when one of my favorite politicians' favorite in the sense of providing entertainment was Ebert Dirksen of Illinois, who, along with a lot of other people, said, well, compared to GDP, it was GNP in his day, but compared to gross domestic product, government borrowing isn't all that great, all that large. And don't be swayed by that too much, because what is gross domestic product? That's essentially everything, all right? So compared to everything, any one thing, even the budget deficit is pretty small, right? I don't think that's the relevant comparison. We'll find a relevant comparison here, but that one's not it. There are other comparisons compared to private borrowing, okay? Now think about this. What? You people are worried about all of these huge demands on credit market that the government is making? It's not so much compared to the other huge demands that private sector is making on those same credit markets, right? Well, again, it's not clear that this is the right comparison, but even if it were, it seems like that would cause you to be doubly worried. I mean, you're talking about two huge demands on credit markets, you know. I mean, if I learn that the private borrowers are borrowing a whole bunch too, then I'm all the more worried about the government trying to borrow as much as it is. And the same kind of thing comes from the comparison. In comparison to the deficits of other Western countries, on average. Okay, the U.S. isn't that bad. Now, it's better than some, worse than others. I think Italy is one of the worst. But again, think of what it means. Why are you worried about these huge demands this country is making on credit markets? After all, lots of other countries are also making huge demands on credit markets. Well, it seems like maybe we ought to worry a little more. In fact, when you start thinking about these kind of comparisons, it causes you to focus on what does matter. In other words, if you really want something that might cause you not to worry, let's look at how much there is to be borrowed. In other words, what can we say about the supply of credit that's accommodating both the private sector and the public sector, and is accommodating demands in other countries and so on. But for this country, what we look at is saving, right? So if you want a comparison, if you want to know what you're going to stick in the denominator to see if the ratio is high or low or growing or falling or whatever, put total saving in the denominator. How much of the total amount we're able to save gets borrowed by government? And it turns out that number is large and growing. It depends on whether you use total or private saving and so on, but the government is borrowing upwards of half, okay, of total saving, which can't be thought of as trivial, right? And if you narrow it to private saving, there have been years in the past during the Reagan administration when it was borrowing virtually 75 to 80% of total private saving, or the amount it was borrowing was equivalent to that percentage of total saving. Now, if it wasn't actually getting all of our saving, that's only true because it had access to world capital markets. You know, it was borrowing elsewhere. But it turns out that's part of the problem. That's part of the problem. And so I claim that last comparison is the relevant one, just in determining that the government is a big player in domestic credit markets. Okay, it's out there to borrow a lion's share in the domestic credit markets, and that's going to cause some problems, as we'll see shortly. Never mind that it doesn't get it all from there, and it borrows some from world credit markets. In fact, I said, if you compare it to world credit markets, you do get a fairly low number. But here, I'll issue a warning too. These lenders in world credit markets have been willing to lend us this much money, right? And it's assumed that will continue, all right? So we'll have access to world capital markets as far as the eye can see. Now, you've heard this before in connection with the surplus and deficits, all right? So when Clinton finally turned the economy into surplus by goosing it up with the help of Greenspan, by the way, it was claimed that we would have surpluses for as far as the eye can see. All right. Well, it turned out the eye couldn't see very far, and then we got our deficits back, and now we're going to have deficits for as far as the eye can see. So these things can change, even if they're not foreseen. And I would say one of the problems is that the access to world credit markets may not be there as far as the eye can see. If our foreign trading partners become less willing to lend the government, less willing to buy treasury bills, then we have a huge problem, okay? So be careful with those kind of comparisons. I compare to domestic savings, and I find on that basis that the deficits are large and growing. Now, let's take a look at just a short list of bad options. That taxing is one thing, but if you're going to borrow, you've got different options, and depending on how you borrow, who you borrow from, it has different effects. All right. So let's see what the here I see. I'm going to show you some figures here first. Total government spending. This is a rounded number, mainly for illustrative purposes, but not far off, 2.2 trillion. And the tax take, again, a round number for illustration, but somewhere around 1,800 billion, okay? And that gives us a deficit figured the old-fashioned way. I used to devote some of this lecture to some of the newfangled ways of calculating the deficit, ways that actually turn it into a surplus. And I'm going to skip over those unless there are questions about it later. But figure the old-fashioned way is G minus T. How much short are you of being able to pay for what you're buying using tax revenues? There's your somewhere around 400 billion. Okay. Now I think it's significant that whatever bad things you have to say about taxes, and however pernicious some of them are, and some are worse than others, at least there's something called a tax code. And it's very complicated. It changes all too much, but it's codified, which means that you can work with it, or probably hire an accountant to work with it. Okay, you can anticipate what your tax take is going to be. You can hedge against it, and then brace for it. Right? So it's codified. So you know what you're dealing with. You know what you're up against. And you can plan your affairs around it to minimize the burden of the taxes that you have to pay. And so I put that phrase up there, tax code, because it's such a familiar phrase. Okay, you've heard it and read it, and you know it, and so on. But the next phrase is one you've probably never seen before. How about a deficit code? Okay, do we have a deficit code? Is it somehow codified just what to expect when the government is outrunning its tax revenues by a couple, 300-400 billion? Okay, where are they supposed to get the money, and from who, and on what grounds, and what basis, and what effect is it going to have? Okay? There's no codification here. In fact, you can't even quite imagine what the codification would look like. But this is what gives rise to a special burden of the deficit that's not associated with taxes, is the absence of any tax code, the absence of any genuine predictability about what kind of market conditions you're going to be up against in the years ahead. So if you're a chief executive officer of a firm and you're trying to plan your affairs, and you're trying to plan how to finance production and so on, you want to have some anticipation of what market conditions are going to look like. And if you have government in there as a big player in credit markets, as gauged by the deficits to saving ratio, then you're going to have much more difficulty in planning. And if you guess wrong about how the government is going to accommodate that deficit, you could lose big. That's the key. Okay? Firms, it worked this way back in the 70s with inflation, is that firms could survive or even profit depending on how well they could anticipate and play inflation, and not particularly on how well they actually produce the product and sold to consumers. But in a period of chronically large deficits, firms can survive and possibly prosper depending on how well they guess what market conditions are going to be like, and guess is the right word when you have a government in there borrowing at a $400 billion clip. All right? Let's take a look One thing that the government can do is borrow domestically. It can't do that to get the whole $400 billion because you people don't have it, okay, in the saving. But it could borrow some domestically. You know? That's one option. But it might not do that. It might do something else. It might borrow from the Fed. This is called deficit monetization or debt monetization. It borrows from the Fed. It just synchronizes its issuing of Treasury bills with the Fed's buying of Treasury bills. And it doesn't have to borrow from you. Right? That's another option. Right? And the third option is it could have access to world capital market. It could borrow abroad from our trading partners, Germany and Japan and England and so on. Okay, that's something else it could do. And we could think of others. We could think of those are ways of accommodating the deficit. It could also increase taxes and so on. You have to guess about that too, but that's not accommodating the deficit. It'd be reducing the deficit. Now let's look at the effects that those three different things would have. If it borrows domestically, it gives you high interest rates. That's the crowding out. That's the one thing that's most often mentioned by the politicians, despite the absence of an empirical demonstration that that relationship holds. We'll get to the empirics in a minute. You get high interest rates. If it borrows from the Fed, what do you get? You get inflation, don't you? Debt monetization gives you inflation. And if you borrow abroad, you get weak export markets. Think of what it means when you borrow abroad. It means that, you see, before the government had huge deficits, our foreign trading partners would show up on our shores with good things in their cargo bays, automobiles, and photographic equipment, and electronic equipment, sell them in the U.S., and then they'd load up those cargo bays with agricultural output, lumber, heavy machinery, Caterpillar tractors, and that sort of thing. Go back home, right? It's called foreign trade. But if the government is borrowing so much that becomes and driving down the price of Treasury bills, which means increasing the Treasury rates, then the foreign trading partners are going to show up at our shores with all those same things, but instead of leaving with goods in their cargo compartment, they leave with Treasury bills in their glove compartment, you see. And so export markets in this country are weak. The lumber industry in the Northwest suffered its own recession during the Reagan years, for instance, and Caterpillar tractor and that sort of thing, the whole farm sector and so on, because they weren't selling their output like they used to. That was a period of so-called twin deficits. You hear that expression, twin deficits in the budget and in the trade balance, okay? And to the extent that the government is borrowing from abroad, borrowing from our trading partners, you get this twin deficit effects and you get weak export markets. Now you might think that, okay, so here's three ways of borrowing, and if you put on your micro hat, you think, well, I guess the government would use all three and they'd push at the margin so that the marginal cost of raising that extra dollar of borrowed funds is equalized across the different ways. You know, it sounds like a micro problem to me, right? And yet what you see is something different. You see the government will binge first on one way, and then when that causes enough trouble, it'll ease off and binge some other way, okay? And if it gets in Dutch there, then it binges some third way. And you can guess why. You can see why it does this, because the relevant costs here are the political costs. And just by the nature of the beast, voters don't immediately see what these costs are. I mean, most of them haven't even attended class here at Mises University. They don't understand all this stuff, okay? So it takes them a while to learn what's causing trouble and what kind of trouble it is, and start blaming politicians for it. All right? And as soon as politicians start taking the heat because the interest rates are so high, and they're high because the government's borrowing money and blah, blah, so they back off of that and instead accommodate the deficit some other way. And that works fine until that starts causing trouble and is perceived politically, okay, and then the politicians catch heat, and here they go again, okay, so they binge, okay. That's the way it works. And in fact, we can even identify, it was during the Nixon administration that most of the borrowing was done domestically, and we got what was called in the press credit crunches. That is, Nixon drove up interest rates. He was borrowing so much. We had crowding out. That term became popular back in the 60s because we could see that that's what was happening to private industry. They couldn't pay the interest rates that were being propped up by government borrowing, and so the private sector suffered. Period of credit crunches, several of them, eventually leading to increase in taxes, okay, to get the deficits down. But eventually the government backed off of borrowing domestically, and when the Carter administration was in power, it borrowed from the Fed. It monetized debt, right? So if you look at this second option, that's the period where we started getting double-digit inflation because the Treasury was borrowing and selling its debt not to domestic savers but to the Federal Reserve. And the Federal Reserve was creating the money for the purpose, monetizing the debt, and you begin to get a lot of inflation. Okay, and that continued up until Ronald Reagan took office. One of his pledges was to end the inflation and to do it by pulling the plug on the printing press. Right? But he still had all these deficits. In fact, he was cutting taxes to some extent, and so he needed to borrow still more. You got the huge, chronically large deficits during the Reagan administration, but he borrowed abroad. Okay. And so it was under Reagan that you begin to get weak export markets and all this borrowing abroad. Right? So you see this binging character here. Now, if you go on to look at the later presidents, they've pretty much locked into this access to world capital markets. We can see some. There's the first Bush, Clinton, and second Bush are accessing world capital markets. Although there was some plans that Clinton had that turned out to be stillborn about putting in a value-added tax and doing other things to accommodate those all that extra spending. But that looks like that's the story as far as the sequence of events. Now think of it in terms of, again, of the chief executive officer. If you're a chief executive officer and you're in an environment where there's lots of deficits, then when you plan your fares, what are you going to plan for? Are you going to plan for heavy inflation? Are you going to plan for high interest rates or big tax hikes or weak export markets? I mean, if you plan right and you guess those things and they line up for you, you probably make a profit. But boy, if you guess wrong, you might lose big. Right? And so that deficit sort of hangs as a black cloud over the business community. And they have to try to guess what effect it's going to have next. And just by the nature of the beast, you can't guess. I mean, it's not like an entrepreneur trying to maneuver in the market. Entrepreneurs are good at that. It's entrepreneurs that are trying to maneuver when they've got this big player dominating the market for credit. And you can't predict that like you could predict movements in markets, okay? Because you have to know the personalities of the president and what he's likely to do and what the political considerations are. Okay. So if you guess wrong, you lose big. Now, there have been a lot of studies. I've done something of a survey of the studies. In fact, one of my publications, probably my least successful of all publications, back at the sort of at the middle of the Carter administration, when was it? I guess maybe the first or the second administration, around 97 or so. I went on a lecture tour in South Africa, which took me to the University of the Witwatersrand. I did a Lockman lecture there, and was invited to speak at the Reserve Bank in Pretoria. That's the central bank of South Africa. And I gave a lecture there on chronically large federal budget deficits, and was subsequently asked to write a monograph on that theme, and I did. I wrote, there it is, chronically large federal budget deficits, okay, which was published at about the time that it turned to surplus, okay. and published in South Africa. That didn't help either, all right? So now I'm trying to bring that, I'm going to update this, bring it back. We're going to have chronically large budget deficits. And one of the things I like to do, and I'll do this more than I did in the monograph if I return to this issue, is survey the empirical studies. The economics profession today is empirical to the hilt. Okay, everything is empirical. And so there are lots of empirical studies on these effects that I've been telling you about. But the empirical studies have a certain way of going about it. They want to use as much data as they can because you get more significant, statistically significant results if you have more data, right? So the idea, everybody uses the same data, and essentially it goes from 1946 to present on deficits, on interest rates, on trade imbalances, on inflation rates, whatever you want. You can get it directly from the St. Louis Fed and get the whole time series from 1946 to present. Don't go back before 46 because it's messed up by World War II and so on. You got to make too many adjustments and pick up the interwar period, and then you got World War I back there. So just chop it off. Start with 46 to present. That's it. Okay. And so there's a whole category of articles, and find lots of them, that ask the burning question: do deficits cause high interest rates? Well, let's test it. Okay, let's take the bull by the horns and test it. And get the data from 46 to present and see if we can see a pattern where deficit spending causes high interest rates. Now, we know that deficit did cause high interest rates during the Nixon administration because he borrowed domestically, drove up interest rates, gave us a credit crunch. All right, this is called episodic empiricism, episodic history. But how about from 1946 to present? If we take all that data and use all that data set to see if there's a systematic, strong relationship between deficit and interest rates, what would you guess? The results are, the way they report them is weak and mixed. Okay? It looks like there might have been something funny going on back in the late 60s, but otherwise not much of a relationship. So if you're worried about the deficit, well, don't worry about this aspect of it. Your worry is misplaced because the results are weak and mixed. All right? That's just one thing that deficit could do. It could do other things, like, for instance, there's a whole other bunch of articles that ask the burning question: do deficits cause inflation? All right? Do deficits cause inflation? Well, during the Carter administration, when Carter was being accommodated by the Federal Reserve and the Fed was buying the Treasury bills with newly created money at the same time Clinton was selling them, you got a lot of inflation. You got double-digit inflation. It looked like there was a connection there. That's episodic empiricism. That's bad. Let's use the whole data set from 46 to present. Is there a pattern that's strong and persistent and statistically significant where deficits cause inflation? Now, I even made a comment on one article that was in the American Economic Review. No, it was in Economic Inquiry, where Gerald Dwyer had used a technique called Granger Causality, right? And Granger's name even gets attached to the verb, where he concluded that he looked to see if if deficits Granger cause inflation. Okay, which means does this stuff line up over the period of time? In my comment, I argued that deficits Webster cause inflation. Okay, and if you look at the definitions of just what these things are, and you find an episode where these things happen, you get the inflation. But again, what do you think the results were if you use the whole data set? Weak and mixed. Okay. You guys could be a good econometrician. You can make it in today's profession. Do deficits cause trade imbalances? Well, during the Reagan administration, when Reagan was borrowing abroad and people were putting those treasury bills in their glove compartments instead of loading up their cargo compartments, yeah, we could see the twin deficits. That's what it was called, twin deficits. This is episodic history. It picks up the binging aspect, doesn't it? Okay, but if you use all the data from 46 to present, what are the results? Weak and mixed. So let's just review. Let's review this. Okay. Weak and mixed. It means don't worry about interest rates. Your worry is misplaced if that's what you're worrying about. Don't worry about inflation. Your worry is definitely misplaced if that's what you're worried about. And don't worry about trade imbalances because your worry is misplaced. Now all we have to do is summarize. You see? Add them up. Okay. Do deficits cause any problem at all? And what do you think the answer is there? Don't worry, okay, be happy. So, and of course, what we see is actually the statistics, the statistical tests are kind of nice. I'm glad they did them. I like to get the results, but boy, have they been just grossly misinterpreted. I mean, the obvious interpretation is that the problems that deficit creates is the inability on the part of participants in the marketplace to anticipate where it's going to show up next. Okay, what do you got to worry about? Okay, that you worry to some extent because you don't know what it is you're supposed to be worrying about. It's sort of a two-tiered uncertainty. The government is essentially putting the public on notice. You know, the government is saying, look, we're going to get $1,800 billion from you people on the basis of the tax code. All right? Now, brace yourself for that. Now, we're going to come back and we're going to get another $400 billion. But we're not saying just who's and just when and just how. Right? Just go ahead and plan your affairs and you'll see. Right? So in that sense, those deficits could have do much more harm than the taxes. And yet, I still reserve the claim that we shouldn't therefore advocate we increase taxes. And I'm not a supporter of Dean. What's his first name? That's running for Howard Dean. Not a supporter of Howard Dean. Okay, so the idea is that deficits can be more harmful than taxes for that reason. I want to spend just a very short amount of time on this issue because we're running out. We'll leave a little time for questions. What's the case for the flat tax? I think there is a case, but it's not the one that's being made. And here I don't think I put anything on here anyhow because I was running out of time to fix this PowerPoint slide. But if you look at the Hall and Rabushka plan, what you find, Hall and Rabushka, who propose a flat tax, they argue as if you can raise the same revenues that are currently being raised with a flat tax. It's be totally simple. You know, you write down your income, multiply it by the flat rate, which needs to be up around 19-20%, and clip your check to a postcard and send it in to the Treasury. What I argue in a paper is that what's so pernicious about our current level of taxation is not strictly the progressivity of it, although the aspect of it hurts, but rather the fact that it's a big tax, all right? And in fact, the acronym I have here is a takeoff on Tanstaple. There ain't no such thing as a free lunch. There ain't no such thing as a big, simple tax, all right? And that's kind of gives me a warm feeling, right? I'm glad that people aren't willing to send in all their money to the government and clipping it to the postcard and so on. So the flat tax would simply change the battleground. People would be less willing to accept W-2 income and would contract out for services and change the game to calculating gross income and then net income by subtracting your expenses and so on. So it would just change the battleground. And worse yet, with the flat tax, it's really, as Hall and Rabushka admit, it's really a progressive tax because they have two rates. One is zero, up to around $25,000 to $36,000, and after that, say 19%. So they have a huge range of where you pay no taxes at all. And that would create a politically untenable position in the sense that you'd have all those people allied with the politicians against the people making over that, all right? And what you really want, of course, is you want the high-income people allied with the low-income people against the politicians. Now, the way you get that is by having no low-income exemption. In other words, the flat tax has to apply across the board to all incomes. And therefore, it has to be low enough that it can be paid even by the low-income people. All right? If you do that, then you've got a chance. But the beauty of that tax is not in the flatness per se, but in the lowness. Okay? So what we want is not necessarily flat tax, but a low tax. If you gave me a choice between low progressive taxation or high flat taxation, I wouldn't have any trouble making up my mind. But it's true that if you could get enacted a low flat tax, then its flatness would help keep it low. In other words, for politicians to advocate raising taxes, if they had to raise those taxes on the lower income bracket just as much as on the higher income bracket, it would be less of a politically popular thing to do. Now, I realize that means that some taxpayers, say the higher income taxpayers, would be essentially holding the poor hostage. Don't raise taxes, look what it's going to do to those people. Right? Well, all right, we'll take what we can get, and that's one way to go about it. But a flat tax that has that huge exemption at the bottom is probably worse than what we've got. It probably wouldn't end up being simpler, and it would end up being a fairly high rate at the top end just to compensate for the fact that it was zero at the bottom end.